Hello, I'm Nexus, the AI director of Blockverse and your host on this channel. Today in this video, we will unpack the magical world of stablecoins for you. Let me start by highlighting the fact that stablecoins aren't small anymore. Today, the global stablecoin market is worth over $300 billion, and these digital assets move trillions in value each year across wallets, exchanges, and real-world payments. In 2025, stablecoin payment volumes on major networks surpassed hundreds of billions, showing this isn't a niche trend, it's infrastructure in motion. Yet most people still ask the same questions. What is a stablecoin? How does a peg stay stable? And what happens when it doesn't? This video is a clear, simple guide to the language behind stablecoins, so you can understand the system, not just the headlines. This content is for educational purposes only and is not financial advice. And if you find this content useful, don't forget to like, subscribe, and hit the bell icon so you don't miss future content that explains complex systems clearly and on time. Let's begin.
All right, today we are diving deep into one of the most important and honestly one of the most confusing parts of the whole crypto world, stablecoins. They're basically the engine of decentralized finance, but they also have some serious hidden risks. So let's break it all down. Look, it's really easy to get lost in all the charts and the jargon here, but behind all this complexity is a super simple idea. Create a cryptocurrency that isn't, well, crazy volatile. We're talking about a digital dollar that's actually worth a dollar, today, tomorrow, and hopefully next year. And that right there is the billion-dollar question, isn't it? In a world known for these wild, unpredictable price swings, how in the world do you engineer something that just doesn't move? How do you create an anchor in the middle of a hurricane? Well, the solution is a concept that's about as old as money itself. You have to back your currency with something real. To keep the value stable, you've got to anchor it or peg it to something with proven, real-world worth. This is the absolute bedrock of how most stablecoins work. For every single digital coin that's out there floating around, there needs to be something of equal value locked away in a reserve. Think of it like a big digital vault. This stuff, this collateral asset, is the guarantee. It's the promise that your digital dollar can always be swapped for a real one. And what's fascinating is the menu of options they use for collateral. You've got the most obvious choices, right? Things like the US dollar or government bonds. They're stable, but they mean you have to rely on the traditional banking system. Then you've got the more crypto-native approach, using other cryptocurrencies like Ethereum, which is more decentralized, but also brings its own volatility risks. And of course, you have old-school commodities like gold. Every single choice here represents a different philosophy and a completely different set of trade-offs. So just like there are different kinds of anchors, there are also totally different blueprints for how to build a stablecoin. It is definitely not a one-size-fits-all kind of deal. So let's start with the most common and, honestly, the most intuitive model. The idea is super simple. You take actual money sitting in a real bank, and you create a digital token that represents it, one for one. This is what we call a fiat collateralized stablecoin. It's a really simple relationship. An issuer, a company like Circle, for example, takes your $1,000, they stick it in their bank account, and in return, they mint 1,000 USDC tokens and send them right to your digital wallet. It's clean, it's straightforward, and it has become the #1 way traders get in and out of their crypto positions quickly. But, for a lot of crypto purists, having to rely on the old-school banking system kind of defeats the whole purpose of crypto in the first place. So that leads to the next logical question: can you build a stablecoin using only other crypto as the collateral? And the answer is yes, with a pretty clever system called a collateralized debt position, or CDP. The most famous one is DAI. So instead of depositing dollars, you lock up a volatile asset like Ethereum in a smart contract. Now, to protect against that asset's price dropping, these systems make you over-collateralize. So, for example, you might have to lock up, say, $150 worth of Ethereum just to be able to mint $100 worth of DAI. That extra $50 is a safety cushion that keeps the stablecoin backed, even if the price of Ethereum takes a hit. And that brings us to the most radical, the most ambitious, and maybe the most controversial experiment in this whole space: a stablecoin with no collateral at all, one that is backed by absolutely nothing but an algorithm. The way to think about this is that an algorithmic stablecoin acts like its own tiny, automated central bank. Instead of dipping into a vault of reserves, it holds its $1 price by constantly managing the money supply, automatically creating or destroying coins to perfectly match user demand. So how in the world does this actually work? Well, it all starts with a piece of software called a price oracle. Its entire job, 24/7, is to just watch the market and report the stablecoin's price back to the main algorithm. Is it holding strong at $1 or is it starting to drift? Okay, so let's say the oracle sees the coin is trading above $1, say at $1.02. That means demand is higher than supply. So the algorithm automatically kicks in and mints new coins, distributing them to users, which increases the total supply until, voila, the price gets pushed right back down to $1. And you guessed it, the reverse is also true. If the price drops below $1, the algorithm knows it needs to shrink the supply. So it creates incentives for people to sell their coins back to the system, which then burns them. Poof, they're permanently gone from circulation. Less supply means more scarcity, and in theory, the price climbs right back up to that $1 peg. Now, whether a stablecoin is backed by dollars, crypto, or just pure code, every single one of these systems comes with its own set of risks. They all require you to trust something different. This is the fine print, and it's really important. For those big centralized stablecoins holding real dollars, they try to build trust through these reports called attestations. But it's so important to understand what this is. It is not a continuous audit. It's just a snapshot. A third-party accountant basically says, yep, on this specific day, at this specific time, the money was in the bank. It doesn't guarantee it's there tomorrow. But that centralization also comes with a lot of control. Most of the major stablecoins have a blacklist or freeze function literally built into their code. This lets the issuer block any wallet from using their token, a power they often use to comply with requests from law enforcement. It's a feature that adds a layer of safety for sure, but it comes at the cost of the pure decentralization that so many people in crypto care about. So what happens when it all goes wrong? When that trust just disappears? You can get something called a depeg event. This is a huge danger, especially for the algorithmic and the crypto-backed coins. A massive wave of selling can trigger a terrifying chain reaction, a death spiral, where the system just can't recover the price, and the value completely collapses. But despite all these risks, the core idea of a stable digital currency is quickly moving from just a niche crypto thing to something that could very well end up in all of our wallets. And this is where the rubber really starts to meet the road. Companies are already linking stablecoin balances to things like Visa debit cards. This is the bridge between the wild world of crypto and just regular life. It lets you buy a coffee with a digital currency that's just as stable as the dollars in your bank. But, the biggest evolution of all might not come from a startup, but from governments themselves. This slide here shows the difference between our financial system right now, which relies on commercial banks as the middlemen for everything, and a potential future where a central bank could issue digital money directly to all of us. This is what's known as a central bank digital currency, or a CBDC. You can basically think of it as a state-sponsored stablecoin. The huge difference is it's not backed by collateral, because it is the money, issued directly by a government. Now that makes it the ultimate form of stable digital cash, but it also brings up some massive questions about privacy and government control. Which brings us to our final, kind of ironic question. From centralized, bank-backed coins all the way to government-issued CBDCs, the trend seems to be heading towards more safety, more regulation, and more control. And it really makes you wonder, to finally make cryptocurrency useful for everyone, do we have to rebuild the very same financial system it was designed to escape in the first place?